freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, here with Adam Penn. Adam, how you doing?
I'm doing great. I'm excited to do an interview today with Daniel.
I know. Excited to interview him as well. We have had a roundabout way to get connected with him, but we had Aram Sarkisian on the podcast a couple weeks ago, and Aram introed us to Daniel, but we had kind of been involved with Daniel in something else in like another capacity, and so it was it's kind of interesting to sit down. But I honestly, I'm excited about the interview. He's got a lot of I think there's a lot of alignment between his background and ours, and a lot of our audience, and he's kind of had an interesting journey, and now runs a fairly sizable and very accurately named the Alternative Investment Club. We
as well as a fund.
As well as a fund, yeah, they've got a fund, and so we're excited to dive into that a little bit more with him. But yeah, we'll with that, I guess we'll jump right into our interview here with Daniel Holmlund. All right, well, Daniel, welcome to the show. We're glad to have you here today.
It's great to be here, Dustin and Adam.
Yeah, we just talking here before about kind of our connections, and with a friend and previous guest, Aram, and we've co-GP'd on an oil deal together, which is something I would certainly love to talk about more here. But I feel like your background will appeal a lot to our audience, having been at Intel for quite a while, and so would just love to kick things off with kind of your background, and really specifically, I'm interested in kind of like your journey into the alternative investing space.
Okay. Well, I guess I can start with my recent journey, unless you really want me to go back. And I could tell you the story of how my grandfather bought a apartment complex after he retired, and that's the only reason my parents had any inheritance at all. He worked his entire life as a tractor repair man, and bought his apartment complex with his brother. It was 110 units in Aurora, Illinois, and he fixed it up in his retirement, and that's why my parents had an inheritance. That's the really short version of it. But I'll tell you a little bit about my journey. I've been a software engineer for 24 years now, the last 12 of which were at Intel Corporation. And in 2018, I actually started the real estate club at Intel. And so I decided I needed to build my own network of people that I can talk to about investing, and who shared a common interest with me, and who I could go to if I needed to raise capital, and just to bring in educational speakers as well. And so I literally went to Intel HR and I said, I see you have a stock club. I see you have a startup club. I want to run the real estate club. And they said, sure, just make sure you fill out the proper paperwork for all the speakers you bring in. And the other two clubs, they only met on a quarterly basis, and I decided that our club was going to meet on a weekly basis. And so we met, and we continue to meet every Friday at noon Pacific time. And we've been doing that for 6 years. I'm really proud of our track record. We average 47 to 48 events per year, where we have people meet Friday at noon Pacific time. So we ran that internally to Intel for a number of years, and we brought in speakers of all different types. And I started my own company, Good Samaritan Capital, at the same time, which I'm now not doing as much with Good Samaritan Capital. I'm doing most of it with the Alternative Investing Club, which is what we renamed the group to. Because in 2023, Intel laid off, my entire team and several adjacent teams. I had been planning on just working at Intel and continuing to run the club there, and Intel had a different idea. So I've been doing this full time since I began this 6 years ago. We've invested in 3,308 units, 15 different syndications across 10 different states. A couple of oil and gas deals, and a couple of other types of deals as well. But our main focus is on education for the tech investor. And We do that every Friday, like I said, and we also focus not just on real estate. The group actually came to me and said, "Hey, Daniel, why don't you send out a poll to find out, what types of assets people would be interested in?" Because quite a few of them were saying we want to hear more than just real estate. And so that's when we started looking into oil and gas wells, debt validation, litigation finance. We brought in one guy who had a whole passive income fund built around buying and selling expensive barrels of whiskey. And so we also have another group who just was in here a week and a half or so ago that buys and sells airplanes and rents them back to airlines like Alaska and Delta. So they're buying, they're industry veterans who know what they're doing, and they're buying and selling either the airplane itself or actually the engines. So picture this: rather than syndicating an apartment complex, did you know that each engine on that aircraft that you fly is actually syndicated? Somebody owns fractional parts of it.
No idea. That's awesome.
You learn more and more when you're into private, investing in private finance.
That's for sure. That it's funny you mentioned that, because I think that was one of the things when I really first got into this space myself. Like I had no idea it existed, and then I started seeing this, and then of course there's shiny object syndrome that comes, because it's like, holy cow, it's not just like standard real estate or apartment building or self-storage complex. It's everything, right? And all the way down to aircraft engines, which is it's just wild.
Yeah, I was going to say, I'm sure there's a ton of other things that we haven't even discovered yet. So you can fractionally divide up almost anything and lead a group to purchase it. So it's there's a lot of creative investors out there.
Absolutely. If I'm curious, like, how did you the origins of the club, and like how did that grow, and sort of how did you kind of, or was there a moment you realized, oh man, there's more demand here than I realized? Because I think the club's now, is it 1,800 members?
It's 1,300. It was 1,800 when I left Intel.
Okay.
And quite a few people didn't go out with me, and so it's 1,300 now.
Gotcha. But yeah,
so honestly, the clubs, like I said, started in September of 2018, and it was embarrassingly small for the first couple of months. I hated even going to speakers and saying, "Hi, we're the Intel Real Estate Club. Here's all 15 of us."
At least you had the Intel brand to go along with it.
Yeah, and that does, I guess, bring some people in, but it was probably 4 months or so of doing it every single Friday before we broke about 20 to 25 people. Internally to Intel, I was not allowed to send out emails advertising it. I wasn't allowed to advertise it in the hallways. I did actually go to the group that maintained the community calendar, and I got it put on there. And then I went to other clubs and I said, "Hey, I would love if I could put my event on your calendar." And so I actually talked to, I think, the Indian Employee Club, and the Native American Club, and a few of them, and the Jewish Club, and just ended up forming good relationships with all of them. And so a lot of what brought people in was word of mouth, but I started targeting, other clubs and working together with them. A lot of them had great ideas on just how to run the clubs internally and different tools you could use. And so it was really good. And then in 2021, I actually started my own mastermind, and I taught people at other companies how to run real estate clubs in their company. And I helped start the real estate club at Walmart, at Facebook, Google, Apple, and Google already had one. They needed a little bit of a revitalization. At Cisco, at I'm blanking. VMware was the other one. So a couple of tech companies, and we started real estate clubs at them.
That's really cool.
Yeah.
Did you have, so when you, and we don't have to focus all on the club here, but I do find it really interesting, especially because it's that network effect, right? You start talking to people, and you even get into other clubs, and you're able to go off of that, and you're able to really learn from one another, which we've talked about mastermind groups and things like that on this podcast. And so when you left Intel and now you do the alternative investing club. Were you able to draw people off of some of those other clubs that you had started previously, or help start in some of those other companies, or are they still pretty segmented to their own thing?
They're actually pretty segmented to their own thing. My master plan was, I'd work with each of the people that were running those groups and, have a capital raising network.
Hmm.
It turns out that most of the people there kind of went and did their own thing, and I guess that's okay. I still have good relationships with them, but overall, I get to go in and speak at them. We trade speakers a lot.
Okay.
That's kind of what we do now.
What
Yeah.
type of, and this probably, unless Dustin's got one, this is probably the last club question, but what type of speakers do you normally end up bringing? What type of topics are discussed?
Oh gosh, anything related to real estate or passive income. We have a lot of funds and syndication and those
Okay.
sorts of things. Our club has tended to focus more on that. But we also have, people that are doing fix and flips. We have people. We had one person whose whole business was, her business was creating awesome man cave garages, and she was like a 60-year-old lady who just created cool garages, and
Pretty
she'd
cool.
talk about the ROI for the house and how it makes it a cool place, and and how it's an investment. And so, um, and we've had the vice president of Fannie Mae in the club as well. So we've had a spectrum of
That's
people
awesome.
and kind of everything and all in between.
That's awesome. I guess Adam mentioned the this might be the last question on the club. I was just looking at the Alternative Investing Club website
Hmm.
earlier and noticed. I guess do y'all have a fund? Is there an active
Oh yeah, yeah.
investment fund?
There is an active investment fund. First of all, we do actually publish all of our events, so they're all up at the alternativeinvestingclub.com if you want to go back and honestly, there's only about 4 out of the 6 years that are up there, but we have quite a few events that are up there. And but the fund itself, what we do with the fund is our core value at the club is to provide paths of opportunity for investors to get into private investing. And whether that's through education, the fund is also part of our core values there. And what we do there is the fund tends to partner with semi-institutional and institutional style investments. They're usually investments that have $100,000 or $200,000 minimum. And then our fund has a $25,000 minimum. And so there are three ways that I bring speakers into the club. One is through education only, no sales pitch. Next one's sales pitch, that's paid. Third one is if you're a club fund speaker. And the club fund speakers, what we do for them is we let them give their pitch, and then at the end we send out a call for capital. And any capital that we raise for them through the fund, we earmark for that particular group. And so it helps us build a really diverse set of business strategies into the club fund, and lets club members get into institutional style, investments at lower minimums.
That's awesome.
Yeah.
Is I guess so. If someone were to invest in the fund, do they have any say in then the fund's investment decisions, or is it one of those? I forget, the customized fund has kind of become a very common thing nowadays, where you can kind of pick and choose like specific investments
Right.
within a fund. Is it set up that way, or is it just invest
It's
and you
actually
kind of
set
get
up as a
exposure to everything?
standard fund. I actually did give serious consideration to making it a customizable fund, and there were a number of drawbacks in my opinion about
Yeah.
that. I know every investor always wants to just choose the things they want, but I personally was looking for a diversified opportunity. But the real drawbacks are that customizable funds incur a lot more CPA fees, a lot more tax preparation fees. The fees are just in general higher.
Yeah.
And us being a club, I really want to run this fund as low fee as possible. On occasion, if there's something that, like for instance the oil deal that we did together, um, that actually we were not able to put into the fund because the tax structure is different for the oil
Yeah.
deal. The people that invest in it actually can offset their active income and taxes,
Mhm.
not just their passive. So the tax structure was different, and I talked to our lawyer about it and our CPA about it, and the problem was is if we put the oil well in the fund, it would have converted all of the the tax implications to passive tax implications.
Yep.
One of the major reasons you do that is to offset your active income.
Yeah,
So
that doesn't quite work.
yeah, on occasion we will take opportunities that don't fit within the fund model and run them as separate SPVs, separate independent opportunities.
You mentioned diversification, and and we've talked about a lot of different things, right? It's not just straight up real estate. And I'm curious, like how, kind of how you approach building a diversified portfolio, and kind of if there's any, if you hear common themes among folks that speak to the club that would talk about this. But I guess the question would be from the point of view from a passive investor's perspective, or someone that's in tech, like what's your perspective on building a truly diversified stream of passive income?
Well, so there's a couple in particular with regards to the fund, there's a couple of things you have to juggle in order to bring them together. And one of them is the liquidity of the fund. So funds will oftentimes have a obligated hold period. In fact, not sometimes, they all do. There's an obligated hold period. And that hold period, if you're in a syndication, you often hear a syndicator saying, oh, we're planning on holding it for, 4 to 7 years, or 5 to 8 years, or 3 to 5 years, whatever it happens to be. With funds, in order to make sure that they can actually buy an asset, own and operate the asset, and then dispossess or sell the asset, there has to be a hold period in there, and that affects how the fund performs and what types of opportunities it can be involved in. And so our fund is a 3-year hold. And so what that means is that we have to balance things that are more liquid, that we can get in and out of quickly, with things that are longer term and perhaps have a better return profile. So that's one thing that I have to keep in mind. We tend to use 30-day treasury bills and real estate debt funds that have high liquidity. Some of them do have like 90-day liquidity. And so you can find them or 3-month liquidity. So we'll maintain some of our fund in that, which gives us the ability to, if we need to, we can sell a portion of it within 90 days if an investor needs their money back, or if we're saving up to buy something which is like a 5-year hold that maybe is 18 to 20% IRR. So it's better than the debt fund, which is returning 9 to 11%, but it's a longer lock-in period.
Yeah. So
you really have to balance those. The other thing is cash flow. We focus a lot on cash flow. Mainly because if your opportunity is not cash flowing, it's difficult to be transparent to the LP investor. I'm not saying that it's not a bet, that appreciation only opportunities can't be good opportunities. It's just from the investor's point of view, it's hard to know if your asset's actually performing until the very end. In which case, surprise, it wasn't.
Yeah, and we've talked about some of that. Just comparing development deals to a treasury bill, right? I mean, it's just totally different ends of the spectrum. And we also run a fund for it's a preferred equity fund that we're working with Aspen Funds on, and so it's got a 2-year lockup and then a 90-day liquidity on the back end. So similar, you can balance those things out. So it's interesting to hear how you balance those, and it's interesting to hear how you balance those and how you're able to reposition part of your fund into another asset.
Yeah, kind of the idea is you build up more and more and more of that short-term liquidity until you can put it into a big chunk into something that's better. And usually, a lot of opportunities, they'll say, hey, if you bring $1 million into it, we'll give you a better return. Mm-hmm. We'll give you 10% rather than 8%, or 20 instead of 18. And so you try to earn up to that point, put it in.
Makes sense.
I think that's interesting. I know, Daniel, you're talking about that really in the context of the fund, but that same approach could apply to an individual investor's personal portfolio, right? Like you could take the same approach to, how do I maintain liquidity? Because that's one of the complaints when new folks come into this area. They're like, oh man, you're talking like I got $100,000 check, and like it's going to be 5 years until I see that money back. And for someone used to investing in stocks and having a lot of liquidity in their brokerage account, that's a bit of a shock. But when you kind of take this portfolio approach to things, you can sort of engineer a way around some of these issues. And I think like what you just laid out, even though it was in the context of the fund, would be very, very good for any individual investor to do on their own. And it would apply and would kind of solve some of those problems.
In fact, if any of your investors are interested in getting into being a general partner and doing loan guarantees, so that when you go to get a commercial loan on a property, for instance, the bank is going to ask you, who are your loan guarantors? They're the ones who basically they have to submit proof of their net worth, and their net worth must combine to be the value of the loan. Yeah. And those people actually have requirements put on them that they have to maintain liquidity.
Yep.
In case the bank wants their money.
No, that's very true. And I guess to not to completely shift topics here, but we were talking earlier about, I guess before we hit record, we were talking about the environment the last few years has been challenging, and some deals have gone belly up, and there've been some issues there. And I know that you've had a lot of exposure to a lot of different deals. And I'm just kind of curious if, like, taking the learnings from all of that experience and also the past couple of years, putting on the passive investor view, like, what are some things some red flags going into a deal? Or if I'm a passive investor, I've got a deal that comes across my desk, like, what are some things that really I should be looking out for that might, we can never perfectly project the future, right? But like, what are some things that kind of will inherently make a deal riskier or more likely to potentially have issues down the road?
Well, I might be a little overly risk adverse. We've done one deal in the last 2 years.
Wow.
So, and my thesis changed about 2 years ago to the point where I don't do any syndications that are value adds currently. Now, that isn't to say that there aren't good ones out there. There probably aren't. I'm probably missing the opportunity there. But the last deal we did was a deal where the city of Houston actually, well, let me answer your question, then I'll go into the story. So it's hard to tell from the sponsor, what their track record is. One thing that I've noticed is that some sponsors have slightly different philosophies about how to handle, does the project come first, or does the investor come first? And there are certain areas where those two things can conflict. Yeah. For instance, specifically, when cash flow gets tight, do you maintain that distribution, or do you put more into the project if you're still in the renovation stage? So there's definitely trade-offs, and I've seen different operators legitimately choose either way. I mean, you can make an argument that putting that money into the project now is going to give you a longer return, better return in the long run. But, if you cut off the distribution, the investor is not going to be happy. Yeah. Now, that might be coming up anyway. But so ask the sponsor questions like, where would you put if cash flow was restricted, where would it go? You want to make sure that you are with somebody who can actually provide details of previous investments. You'd be shocked how often, maybe not, but I would say, maybe even a majority of people out there just don't provide information about their previous investments. Yeah. And so I tend to err towards working with larger groups that have track records that are well published. One of the other red flags is, of course, communications. It's terrible being with a syndicator whose communications are not good. So make sure you have someone whose communications are good and you feel like you're comfortable with them, and who communicate, on a monthly or a quarterly basis, something to that effect. But it's known ahead of time how often they're going to communicate. For preferred equity deals, those are pretty tricky. Some of those might be rescue capital, some of them might not be. So there's definitely some niche situations there, and asking what rights does the fund get when they're putting money into preferred equity. Can they force a distribution? Can they force a sale? Can they take over for the asset management? All those sorts of things. For just the standard LP that's out there, I would say just find a group that's got a good track record and good things are said about them, and ask other people what their experience has been, and run background checks on people. There are background services out there that, $30 a month, and you can run, a certain number of background checks. So make sure you do that as well. Sometimes I've found that the sponsors are okay, and they're people that, would be great and I would feel very comfortable investing with, but a service they're using, like maybe their legal service, has had problems in the past. And so sometimes you have to actually ask them, who does their marketing, who does their legal, who's their CPA, and look into them too. I'm not saying you have to in every case, but sometimes it can bite you when you don't.
That's really good. Adam, you have any follow-up questions on that?
One thing I think was interesting there, and I think I actually have a little bit of it, maybe not a difference of opinion, but something that I'm curious about, right? So one of the things you said was to run background checks on people, and I've heard that, and I've also heard people argue that it's useless. And the main argument I've heard is like losing someone's money doesn't show up on a background check, right?
That's true.
There are things you could catch, but and I agree with you. It is probably a good checkbox to check. I'm just not certain. I would add it as a checklist item, not a their background check passed, they're clean, right? It's not a background.
Oh no, I'm
check on the
definitely
deal.
not saying that.
Yeah.
Yeah.
So
Yeah, all of these things are basically building a character profile that you have to weigh.
Yeah. Awesome.
I guess, Daniel, one of the last questions here, you mentioned earlier you haven't done a deal, or you've only done one deal in 2 years, but it's been
One real estate deal.
Real estate deal. So what economic trends, or kind of like what are you paying attention to right now? And then like what do you see, and how's that influencing kind of the deals or deal flow?
Love
or what?
to get into a discussion with you on this. Okay, so I think most people know that over the last 2 years, starting when interest rates rose, economic activity transactions in the commercial real estate space fell as much as 85% across the nation. The industry came to a standstill, and it was only larger capital groups that really got the good projects. All the smaller people got diddly squat. And so you were either aligning yourself with a larger group, raising capital for them, or doing something like that, or you were doing a lot of churn on evaluating deals that just never panned out. I think going forward in the future, we still have persistent inflation problems. I don't think that's going away at all. As long as our government spending is where it is, inflation is going to continue to rise. And so I see that as being something that's going to be persistent into the future. Now, maybe, if the economy starts to create more production, then, inflation is a ratio of the amount of currency out there to the number of goods and services that are out there. So if the goods and services go up, it could bring the inflation down a little. But I think that as our government spends, that's going to cause more inflation because they create the currency in order to facilitate that spending. So I do see this as a long-term issue, particularly now that the size of the debt expenditures, or the interest on the debt, is the largest component of our federal government, except for Social Security and Medicare. It's larger than the Defense Department now. So it's an albatross, hanging around our necks, basically. So having said that, I think that pushes asset prices higher. Usually, we did just come out of a period of very low interest rates where 40% of the nation's residential homes are completely paid off. Yep. Another 35% have it was 30% has 3% or lower in their interest rate, and something like 40% is 4% and lower. I might have those slightly wrong, but a large section of people have locked in their low interest rates. And so that's going to continue to cause people not to want to sell. And so we're going to have problems on the supply side. Right now, if you look at the residential market, there's around 600,000 houses on the market nationwide. Oftentimes in the past, healthy markets were considered 1.6, 1.7 million. Yeah. So we're at a third of what we should be there. And the same, is true with a lot of commercial spaces. Now, commercial spaces do turn over a little bit more because their loans are shorter, and they tend to trigger faster, particularly if you have a variable rate interest loan or a rate lock. So I think that we're going to see a lot of slowdown of activity. And so what that means is that whatever you get into, there has to be a really good reason for getting into it. The deal that we did two years ago, the reason why we got into it was because the city of Houston was saying if you dedicate about 50% of your housing to lower income housing, it technically wasn't classified as low income, but they were low income renters. They exempted our property taxes, and they actually exempted it for a period of 99 years, which I felt almost bad participating in that. It was a very good deal.
Especially in Texas, my word.
Yeah, in
That's
Texas
fantastic.
too. There's no income tax in Texas. Property taxes are the biggest tax.
Yeah.
It was more than 30% of our overall expenditures on the property.
Wow.
So the moment we signed that deal, we had a 30% built-in cushion on that property.
Wow.
And so what I'm saying there is the reason I haven't gone for value add business plans as much is because that's what everybody's business plan is. You really need to look for a business plan that's unique, that takes advantage of the market, or there are a lot of municipalities right now that are offering deals if you work with lower income housing. It can be challenging, but it could also potentially be profitable. There needs to be a little more of a story there than just we're going to fix it up and bump the rents up. To me, rents are very high right now, and to be honest, I think they're still going to go higher. But it doesn't make for an overly or a uniquely compelling story.
Sure. No, I think that's a great point, that there's got to be some unique aspect to the deal, right? Like what's the deal story? I see so many things pitched as it's a value add deal, and it's like, okay, well, maybe there's an opportunity to bump the rents $100 or something like that. Is that the value add?
Yeah.
Okay, then why didn't the existing owner do that? And yeah, so there's got to be like, and now that you say that, like the really good deals that I've seen get done the last few years, there's always been that there's that one component, right? There's like the one really crucial part of the story that made it a good deal. Maybe it was incredibly low basis because of some owner issue or something like that, and that owner had to fire sell, and it was completely off market, but it was still like, that's why that particular deal was a good deal. It wasn't just
right.
It's going to be value add.
There's a lot of good stories in the pref equity markets. If you're going in and you're providing a middle layer of funding there, either pref equity or mezzanine debt, there's a lot of good stories there too.
Yeah, and similar to what you said earlier, most of the ones that we've funded have control takeover rights, and something I like to add there is the operator that offered the pref equity actually able to take it over? If they take it over, are they qualified, right? And I think Aspen has a good track record as an operator to take over a deal.
Aspen's a good group.
One thing that, just to kind of add on to that, I mean, we're underwriting a deal right now. It's small, something for a personal portfolio, but it only makes sense because it's in a flood zone and no one could buy it and get a bank to qualify for. So the owner is going to have to owner finance it at a low interest rate because they know that the property is never going to flood because it flooded there 3 years ago and the water didn't even touch it. So it's just because it's on a flood map, it would kill the NOI, right? I mean, it just doesn't work. So I think that the point that
what do you do for insurance in that case?
You just get everything other than flood insurance. You can still get a regular insurance policy. The lender's not going to require you to carry flood insurance, which a bank would because it's in a flood zone. But I think the thing we're all saying here, right, and really for the listeners, is that deals need to have that uniqueness to them, right? I mean, it's not to say you can't just have a generic deal, but then you're going to be getting that generic deal. It's going to just be clipping a coupon for 10 years, and then the market's going to go up at some point, and you're going to refinance, right? There's nothing that's going to like boost it.
You almost need to think about it as what would you say to your family members around a dinner table? What makes this a cool deal?
Yeah.
And I think there's got to be a little bit of a story you can tell.
Oh, the grass is really green. It's like all the blades are the same height. Yeah.
Yeah, and unfortunately, that is hard to find.
Yeah.
but it's really needed. Yeah.
Well, Daniel, we'll not belabor this too long. I guess one of the questions we always like to ask our guests, we're the Wealth Independence podcast, and so sometimes those words and independence and freedom and those are emotional words. And I'm just curious, like in your life and in your own words, like what do those words mean to you?
That's a really good question. Independence is being able to own my own time. And in particular, I'm at a stage of life where my daughter will be gone to college in another 2.5 years. I want to have as much time here with my family as I possibly can. And so being able to own my own time, to be able to build memories with people, that's what financial independence means to me.
That's awesome. I don't think anybody can disagree with that for sure.
Yep.
Well, Adam, unless you've got anything else any other burning questions, Daniel, we certainly appreciate you being here and spending some time with us today. How can, I guess if folks want to either connect with you or want to learn more about the Alternative Investing Club, what's the best way to go about doing that?
My email is daniel@alternativeinvestingclub.com, or you can just go to the webpage. Okay. We meet every Friday at noon Pacific time.
Is that a Zoom call every week?
We just switched over to StreamYard, actually. Okay. It used to be a Zoom call. StreamYard lets us broadcast it to all the major social media networks.
Oh, that's awesome.
Good deal.
Great.
All right. Thanks again, Daniel. We appreciate it.
Thank you.
All right. Well, that was excellent. I was excited to talk to him, and that kind of lived up to everything that I hoped that it would. The club is super interesting. That's kind of an interesting approach. It seems like it grew fairly organically, especially given the fact that Intel did not let them.
Yeah, that was weird. You can't send out emails about your club internal, but that's an HR approved club. That's maybe they don't want too much spam, but
yeah. But I thought that was telling too. I mean, I guess to the size of the club, and then he was telling us later that they've got, I think he said 1,300 members, but they'll pull 100 every week. So it's a pretty sizable club. And I would say to anyone listening here, one of the things that I say often, if you're new to this space, you got to be looking at deals, right? You need to. We had Adam and I had a mentor who said, if you want to get good at looking at deals, you need to look at deals. And that's exactly true. And I think Daniel's, for anyone here, definitely go out. It was alternativeinvestingclub.com. Go out and join, see some of the stuff that those speakers, he's bringing in some really good speakers. And so, I thought his comments were great. I really loved, I think he answered my question about the portfolio in more from the fund, but then it's very, very applicable. As I said during the interview, it's applicable to an individual investor's portfolio. And I think taking that same sort of approach of like, I need to make sure that I've got liquidity, and then how are we sort of building this to some larger investment that's going to provide equity and cash flow. And I think that's a great approach for any passive investor to take. I don't know, Adam, you had any particular takeaways from it?
I enjoyed the conversation overall. I really like to see the path, right, from when he started, as he was just an engineer, and then we didn't dive a lot into his background, right? He didn't say, oh, well, this time I bought a single family. You always hear it, I bought a duplex, and then I bought another duplex, and now I have $5,000, right? But I like that he talked about some deals that didn't go great. He didn't dive into details, but he said, we've had deals go both directions. He likes his, and that really, I think, ties into his portfolio analysis of how he does it. Same thing as you mentioned. And so I think it's interesting to rehear that, especially from someone who we don't interact with on a daily basis, right? He's not part of our mastermind group. And to see those kind of aligned values, right? We talk about it all the time. Cash flow is the focus, right? If you don't have cash flow, and he brought it about from a transparency aspect, which I don't know if I 100% agree with, but it's just harder to have consistency with an investment, right? And to know it's trending in the right direction, or to cover the things that don't happen, right? Let's just go past the transparency and say, like, we've got a short-term rental fund right now that the market dipped, right? If it had been just an appreciation play and we were waiting on market appreciation, well, the market dipped. So it's good that we're still cash flowing, even though the cash flow's not where it's supposed to be.
Yeah, and I thought that was his comments on the the importance of cash flow, and I really never thought about it from a transparency standpoint, because I mean, he's right? If you're in, say, some development deal that's completely appreciation based, like you hope to have updates from the sponsor, the developer, on how things are progressing, but like how that translates into financial terms is very, very uncertain until you reach kind of that end point. You're really relying on, just the word of the sponsor there, and kind of their interpretation of events and their interpretation of the market. So I do think that cash flow provides some of that. Like, you can't lie. You get that direct deposit in your checking account. Like, that's that's a real number, and you can really gauge investment performance from that.
I mean, we talk about the same thing, even more from our standpoint of sponsors, right? When we send those monthly distributions on the credit fund, you get referrals, you get your reminder every month, right? It's not just an email update saying, oh, well, we did the entitlement work 2 years ago and we're waiting for the city to rezone this area. It'll be done in another 2 years. No, here's this month's distribution. Yeah, for sure. That's a powerful thing, right? Everyone, I mean, no one's going to complain about getting that email that, hey, we've just deposited some cash into your checking account. But yeah, I thought it was great, and again, I would highly encourage everyone here to go out, check him out. We'll link his LinkedIn and some of his other profiles in the release notes, but definitely check out the Alternative Investing Club. It's really neat thing they've got going on there. But with that, we'll Adam, I don't know, unless you've got anything else, we'll. I have a random comment. You said no one complains about getting the email that you've got a distribution, right? It's funny because I do the distributions for our deals, right? And then every month I get a distribution because I'm in some of the deals. I do get excited. You said that. I was like, oh, I get excited when I see the emails, even though I'm the one that pressed the button on the page on the other tab to say send the email to all the investors. And I go back to my email. Oh, I got a distribution.
It's true, right? The psychology's there, even when it's happening to you. No, that's awesome. All right, well, with that, we'll get on out of here. We appreciate everybody listening. Just remember, where freedom leads, real wealth follows. We'll see y'all next time. Thanks.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.